Welcome to Morningstar. I'm Holly Black. With me is Matias Möttöla. He's an analyst at Morningstar. Hello.
Hello.
So you've just released your Mind the Gap report, which is not a study of the London Underground. It's actually about fund performance. Can you tell us a bit what it's about?
Yeah, so the Mind the Gap is, we can say, a classic Morningstar study. We started putting these out in 2005 already in the US, and it's about investor behavior. And it reveals how investors, through often a bit unfortunate timing of their investments, lose a bit to the funds that they invest in. So their average pound or average euro typically does a little bit worse than their average fund.
So this is about, we get our performance figures and we can see those on the Morningstar website, how a fund has done. But if we buy at the wrong time, we might not quite achieve that.
Yeah, so these are essentially the investor returns, or the returns that the investors see on their investment accounts. So they are the actual numbers, and they are calculated from cash flow numbers and net asset numbers that Morningstar gets from asset managers. So it's really giving a picture of what the average investor in Europe has done.
Okay, and the focus was European investors. What are the main findings this time? Yeah,
the key finding was really that European investors tend to lose a bit to their funds, but not that much. It was 53 basis points, so around 0.5% each year. That's still, you know, it's still money.
I still want that.
But yeah, but it's not a. The result is not as bad as some of those that we've seen from our US studies, especially from the financial crisis and then from the IT bubble. So it's often those really turbulent times when investors just are taken through stupid decisions often by their emotions. So it's been a bit more benign market, and that's why investors have done a little bit better.
And how does this compare to what we're seeing around the world?
Well, I was saying good things about Europeans, but it's true that when we compare to other markets, there also the typical picture was that the average euro dollar lost a bit to the average fund, but a bit less than here in Europe. So the gap was a bit smaller. And then Australia was a bit of an outlier, where Australians have a positive gap, where typically, their Aussie dollar does better than the average fund.
And is there a type of fund that is more difficult for Europeans to get right?
Yeah. For us and for all other investors, it's really the very volatile funds where you have a lot of risk. And what that risk means is that, at times those funds do really, really well, and then investors see those return numbers and they jump into the funds, often at times when the actual performance jump has already happened. Then they go up with the fund and then go down and then get frustrated, I'm losing money, I have to get out. And so they sell at the bottom. So that's what very typically happens in these volatile funds.
This is a classic case of buying high and selling low. It's exactly the opposite of what we're supposed to be doing.
And the easier, it seems, based on our study, is really the easier place for investors to be in is in these diversified funds, whether it's diversified equity funds, and especially then in multi-asset or allocation funds, where the risk in general is a bit lower than in equity funds, and also this the work that the asset managers are doing is really balancing the portfolio, and so it's just a little bit smoother ride. And typically those funds are bought for the long run. They are bought not as just as short-term investments to be where you do opportunistic investing, but you just buy and you just have them sit in your portfolio.
So what is the key lesson I should take from this?
Well, it's really that even though it's fascinating to invest in sector funds and all kinds of specialized funds, you should really be careful with that and only do that at the sleeves, the satellites of your portfolio, and rather focus on having well-diversified investments as the center of your portfolio and hold on to them.
Well, thank you so much for your time.
Thank you.
And thanks for joining us.